Welcome to Chit Chat Stocks, a podcast that helps you discover your next great investment. I am one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. This is one of our weekly Power Hour episodes. We've got a couple topics. We had to be a little creative this week. It's dead earnings season. We've got a couple interesting topics, though. Duolingo seems to be getting crushed. People are worried that the business model could collapse, apparently. We've got a number of listener recommendations for stocks to look at. We've got news on Chipotle. We've got, I think, 5 different listener recommendations on companies to talk about. So we're going to dig into all of those. A number of them are new to us, so we'll go through some of them. But before we do, quick reminder, please like or give us a review if you enjoy these shows, and follow us on whatever your podcast player is. So Apple Podcasts, Spotify, that way you will never miss an episode. Brett, how are you today?
Doing well. We got a lot of stuff to cover. Thank you to the listeners for sharing some stocks we want to look at. Just a little tease, some cybersecurity stuff, Internet of Things company that kind of looks interesting, if I'm being honest, a really cheap online gambling company, and of course, some AI stuff. Luckily, as in each week, there is new AI and cloud infrastructure news for us to cover, as well as some bubble watch stuff. And when you said, finding new stocks to buy there, Ryan, we did get a nice review again this week for someone on Apple Podcasts saying that we're a show that helps find new stocks that they can research above all else. That's our goal here. And then the second thing I'll say is we're recording this before the episode is coming out. But for anyone listening on Friday, we recorded an interview with David Gardner. It's going to be out in your podcast feeds. We're super excited about this. One of our Mount Rushmore guests, he has a new book coming out. We asked, I think, a ton of interesting questions, different questions than he gets asked on most financial media outlets. So if you want to hear the answers to those, that's my little tease. Go listen to that one. I think, Ryan, we should start with Chipotle. Multiple listeners wanted us to talk about this one. It's down, I don't know, we can check it on Fiscal AI really quickly here, but it's down significantly from the peak. I'll let you start. What are your initial thoughts on the drawdown and what's happening with this business?
Yeah, maybe you can check the drawdown real quick, or actually it looks like I'm pulling it up here on Fiscal. I believe it's around down like 40% roughly. But I'll double check it here in a second. The question I posed, yeah, it's down 42%. The question I tried to pose to people on socials this week, and I think I already know your take because you came up with this take a couple of years ago, but has Chipotle peaked? So the big thing is that last quarter, they reported -4% comp restaurant sales growth. That is their first decline in comp store sales since the pandemic. But if you exclude the pandemic, since the E. coli crisis. And there have been difficult economic environments throughout that time. Like even during the interest rate spike from last year, they were able to show great comp store sales. And it's really just been overall a pretty solid last 5 years for them, and they've grown through difficult environments. One of the benefits for them is that no, they aren't fast food, but they are a cheaper alternative if you're looking for a healthy option. Like getting a $10 burrito bowl, whatever it is, that's a lower cost alternative to going out to a restaurant, which ends up having them be in sort of the right spot, even in difficult macro environments for consumers. However, right now we have seen an overall slowdown across pretty much all fast casual dining concepts. And part of it is, I think, consumer weakness. That consumers are just maybe dining out less, or they're trading down. We've seen positive numbers from McDonald's and Domino's and Taco Bell, and they've talked about the consumer trade down. But Chipotle's usually been resilient through that type of environment, and the average revenue per restaurant is down over the last 3 quarters now. So I guess my question to you is, do you think this is a temporary blip, and just sort of temporary consumer weakness, or have we hit peak Chipotle? Do you think revenue per restaurant will be much higher in 5 years?
I'm gonna give you the boring answer and unexciting answer and say I'm not sure which factor it is. I think it might be a bit of both. We've seen the macro issues it hit a ton of restaurants out there. I think it's just spending across the board. You've seen companies that are much cheaper or brands that have much cheaper alternatives, such as the Applebee's of the world doing quite well, the Domino's of the world doing quite well. But a lot of these other players, even ones that are relatively cheap priced, like Chipotle, traffic has gone down. I'm not sure exactly what it is. Maybe there's less return to office boost because it's such a lunchtime option. Maybe it's just the fact that they've lost their luster, or maybe they had those one-time deals. They always advertise the special, what is it, like brisket or honey chicken that's always on the TV during sports commercials. That might not have hit this quarter. Who knows? But what I will say is that if you compare them to some of the other fast casual players, such as a Kava, there was people that, I think a quarter ago saying that, well, Kava's gay comp store sales look fantastic, Chipotle's look pretty weak, but now they're kind of tracking pretty equivalent here. Both are seeing declining numbers. I think that is more of an indicator that this is a macroeconomic effect, but I still don't know at a PE, a trailing PE of 36, if I'm confident in buying this. With inflation, I'm sure that their revenue per restaurant is going to it'll be higher in 5 years, but is it gonna significantly outpace inflation like it has been even, in the historical ones that Ryan's pulling up from our friends at Fiscal AI here? I'm not sure. What do you think, Ryan? Hello?
Yeah, they will probably grow at least. Can you hear me okay?
Yeah, you might have froze. I
All
can hear
right,
you now.
maybe I'll, okay, yeah, my internet's a little spotty, but I agree. So, I think they will at least grow with inflation, at least the average, sales per restaurant. I'm pulling up this chart from Fiscal AI, and shout out to their custom metrics feature, just revenue divided by total restaurants. December of last year, they got to about $3.5 million on average annual sales per restaurant. It's come down a little bit since. I have doubts that they will be able to grow faster than inflation on an average, uh, sales per restaurant basis. It just feels maybe it's me as a consumer changing my habits, but it feels like the concept and the uniqueness of the concept, and frankly, my consumer dining experiences there have just underwhelmed, or petered out. Maybe it's more competitive now. But yeah, I agree. Maybe they can continue to grow restaurant count, which will help boost sales, and they'll grow with inflation. But I would be surprised if you get comp store sales that are significantly higher than the inflation rate.
Yeah, I have one more thing to say about Chipotle, but I should mention we forgot to say this at the start. For anyone listening on Friday, we are recording this on Tuesday, September 9th. So if any big news hits Wednesday or Thursday, we're not talking about it. We're going to be at a conference that day and we're recording this early. So if we get anything wrong, any numbers are wildly changed. If Chipotle has another E. coli crisis and the stock is down 30%, that's why we are not talking about this again. We're recording the show on Tuesday, September 9th. But here's what I think has changed about Chipotle. They talk about store count expansion in the United States. I'm not sure how much longer they have to grow store count significantly, given that they're a lot different than some of these other concepts where you're not going to really want the density, I don't think, as opposed to a McDonald's or a Burger King. It's not going to make sense. It's going to become an international expansion story. And, today the PE is 36.4, EV to EBITDA 24, free cash flow ratio 36, right around the PE ratio. Their 10-year diluted earnings per share growth has been 13% a year over the last 10 years. Now, they can expand internationally. They've started a little bit in Europe, a little bit the Middle East. They're planning one in Mexico City. If the concept can succeed in Europe, the Middle East, Latin America, even, If it can succeed in Mexico, I think it can probably succeed everywhere, anywhere. But then if it can also expand to other markets such as Australia or Asia, then the stock probably works here because they can keep growing this earnings per share, whether from a wholly owned model or from a licensing model internationally. If they can keep growing earnings per share at 13%, the stock will work. I'm just not, I don't know if it's a good risk reward at this price.
I agree. I think if you're betting on unit expansion, you're betting that restaurants, like that's the crux of your thesis. There's other bets to make. I mean, even Wingstop probably has a lot more headway to expand restaurant count. Portillo's has a lot more headway to expand restaurant count, hopefully,
Yeah. And
for
their
Brett
comp
here
store
as a
sales
shareholder.
look, they look just as ugly, but the stock is probably at 30% of the price. Um, Even though it hasn't worked very very well in my portfolio this year, it's probably been the one big dog.
Yeah. So short answer to has Chipotle peaked? Maybe, but I don't think it's seems that attractive as an investment here. The second topic I want to talk about, unless there's any pressing ones that you want to get to, Brett, I want to mention Duolingo because some news came out today also, which has created a
Yeah,
little bit of
didn't the new
controversy.
iPhone come out? Or was it announced?
Um,
I think so.
maybe it
Slimmer.
might have
I
been,
think it's
but
slimmer.
the news I saw was that AirPods are going to have live translation. So, and the stock dropped another 4%. The interesting thing for Duolingo is this stock has dropped like 1 to 3% seemingly every day for the last 5 months, is what it feels like. It's the stock overall has been cut in half. I think it's minus 53% roughly over the last 5 months. And a couple things. So, last week, basically the whole theme here, other than maybe a lofty valuation, is that people think Duolingo is going to get disrupted by AI. And there's a couple ways that it could do that. First of all, apparently the Google Translate app rolled out a feature called Practice that will apparently compete more directly with Duolingo, but I kind of shrug my shoulders at that. Like Google Translate itself is a competitor, but teaching someone a new language, like Duolingo already has a ton of competitors on that ground. I don't think this is some revolutionary breakthrough for Google Translate to be trying to teach people new languages. I think most people that use Google Translate use it to not learn new languages for the most part. They use it to translate. So I kind of think that's a little bizarre that the stock sold off so much on that, but that happened 2 weeks ago. And then today, as I mentioned, AirPods apparently came out with live translation, which sounds pretty cool in theory. We'll see how well it works. Google came out with these with actually this exact same functionality, and it's on its what do they call it? Pixel Buds, I think is their term. I think they came out with that product in 2017. So on one side, you've got a whole lot of big techs coming to disrupt them type narrative. Not to mention, apparently there's some third-party data providers that are saying that app usage is down over the last couple weeks relative to last year. It's come down quickly. So I tend to say don't give too much thought to third-party data providers, but it's it tends to have an impact with analysts because people don't want to be wrong in the short term. On the flip side, Duolingo is producing phenomenal results. They continue to grow users. More and more of those monthly active users are converting to daily active users. And the percentage of users that are converting to paying users continues to rise as well. So, as far as mobile apps go, this might be one of the best mobile app businesses out there right now in terms of how they're performing. Valuation wise, the app still has an enterprise value of $11 billion roughly. They're on pace for $1 billion in revenue this year and currently have 10% operating margins. So EV to EBIT is around 100x. They're probably going to see operating leverage from here, but I guess two-part question for you. One, do you think Duolingo is truly at risk of disruption by AI and live translation type offerings? And then two, do you have any interest in Duolingo? Is this something you could ever see yourself owning?
I, I'm not sure on the AI disruption. With the thinking from these people that say, "Oh, look, Google Translate or AirPods or what have you are going to directly lead to people not needing to learn a new language, and then they can directly converse with people." That's going to mean that everyone around the world is going to be wearing either AirPods or smart glasses or something that's going to be this interface in the real world between people. And I think that's either A, never going to happen or take like 20 years to get to that level, especially if you're traveling to a foreign country, which would be the point of practicing on this thing. Another thing is it's more of a game. So the disruption from AI, there's potential for them to expand their offerings and make stuff more personalized within the Duolingo app, but there's also a risk of the commoditization of language training. I think there's an entirely different market of, oh, I want to use Google Translate to converse with someone in a foreign country when I don't know the language versus I want to actually learn the language. So I don't think that's a risk, but am I interested? I I know people love this management team. I think the founder's still running the business. There's people out there that know this business quite well. They've made some great calls on this stock. Obviously the financial history has been phenomenal. I'm just not comfortable with uh, how would I say this? You're going opposite of lethargy of people, of laziness, and I think there's got to be pretty sizable churn here. Speaking personally, there's definitely sizable churn. I go off and on of using the app and practicing and stuff like that. I put it into the too hard pile, maybe by mistake, but right now, I guess it doesn't look like too bad of a mistake. And the fact that you mentioned the valuation, I'll use another way to go about it. EV to gross profit is 18. That's not dirt cheap. Even for a company, as you mentioned, 10% operating margins today, they could probably expand to 30. It still doesn't look overly cheap for my liking. But hey, this management team,
Yeah.
they seem great.
And if if there is this really like if a lot of people are on the fence as to whether or not this is a business model that will be disrupted by live translation, you would think it deserves a bigger discount. Like it's down, even if you assume that 100% of gross profit flows through to the bottom line, it's not dirt cheap if there are some growth headwinds in front of it from live translation. I think it could work. There'll probably be a lot of operating leverage and there's probably more growth to be had, but I think I'm kind of with you. I I do people taking up learning on their own doesn't seem to be like a growing part of the
I don't want to bet on that.
population.
No, I don't want to bet on that. I'd rather buy Pepsi with declining volumes at the right price.
Yeah, maybe it's a pessimistic worldview, but I think you're right. The one thing I will
No, it's
say,
not pessimistic. It's just how it is. Just how you
I
gotta
do
you gotta look at the world how it is, not oh we're doing so good for the world. It's like those stocks that are certified B corporations. That's not gonna get you to buy my stock. Get me to buy your stock. It's actually gonna make me
no.
less interested in buying your stock because 1% of your revenue is getting donated to charity and not me, a shareholder. It's the same
Yeah,
thing.
the only last thing I'll say on Duolingo, I personally feel that the Venn diagram of people who are going to Duolingo to learn a language and those that just want live translation is pretty small. I think the live translation, if you're going to Duolingo, you are at least proactively trying to learn. And I feel like the live translation audience is slightly different, would be my guess. Who knows? Could be wrong on that. Let's get to some stocks that
Well, we have
listeners
some we need to talk about. I just saw this after hours. Oracle reported. I don't know if you saw. Can you guess? This is a market cap of before they reported $680 billion. Can you guess how much they are up in after hours? No cheating in there.
100 billion.
More. 27%. This is gonna lead into an
Wow.
AI topic I think is quite interesting. So they talked about their RPO and backlog. I'm not gonna read through this whole thing, but they say they're going to detail a financial plan in the next month at their analyst meeting. As a bit of a preview, and this is a quote, we expect Oracle Cloud infrastructure revenue to grow 77% to $18 billion this fiscal year, and then increase to 32 billion, 73 billion, 114 billion, and 144 billion dollars over the subsequent 4 years. Most of the revenue in this 5-year forecast is already booked in our reported RPO. Oracle's off to a brilliant start to fiscal year 2026. The
How can they be
AI,
so precise?
yeah, that's true. I guess maybe if they think supply is so restricted and then demand is just going to match whatever they have, but it depends on what you price stuff at. Ryan, the music is still playing and everyone's dancing.
I guess if it's all already booked, then yeah, you can afford to be precise with your estimates as a management team. But on the flip side, why are you if supply is constrained, why are you booking things 4 years out? You could raise prices, right? Like, wouldn't you
Yeah,
wanna keep the windows somewhat tight? Like, you don't that might it's kinda like the Boeing thing where they always brag about their backlog of planes, but the delivery issues are the problem, and now all of a sudden you've got a backlog that is gonna be
prices.
liability.
Yeah, maybe they don't want antitrust stuff. Maybe it's inflation on stuff like this. They don't want issues with that. Either way, I mean, that is quite impressive. We saw someone in the chat here, thank you, Simon, saying RPO is now $455 billion and quadrupled year over year.
Wow.
They could be the fourth horseman here in the cloud uh, data center business. And speaking of, well, I have some of it in Bubble Watch. It kind of can relate all together here. There's two other things in AI infrastructure, as well as one of the stocks we're going to hit later. OpenAI's cash burn projection, according to the publication called The Information, which follows, I think, the Silicon Valley world very well. OpenAI is projecting $115 billion in cumulative cash burn through 2029, up $80 billion from the previous estimates. Here's a quote from the article. The company's cash burn will more than double to $17 billion next year, $10 billion higher than the earlier projection, with a burn of $35 billion in 2027 and $45 billion in 2028. That's a lot of numbers. I'm just going to ask, what point do we admit this is not realistic business? This is not a realistic business model or sustainable whatsoever.
Wait, I'm
When
sorry. That's the cash burn for
this is
Oracle
annual cash
projection?
burn. Yeah, should the quote's a lot clearer. So this is what they're projecting based on their spending plans.
Yeah, I have worries about this. It's kind of I have the
You
same
have worries?
worries.
That's okay. That's the understatement of the
Well,
year.
well, no, I mean, okay. On the one, I would venture to bet that the majority of analysts and the investment community are not worried about them the cash burn, given that they're able to book it in per, remaining performance obligations. Like
Well, this is
you're
OpenAI.
getting
This is OpenAI.
oh okay, then yeah, obviously that's horrendous. That's a big issue. But I thought we were still on Oracle. The
Ryan's internet is not great today, as you can see. His video is stuck in
No, it's been cutting
2015.
out, but I don't see how they turn that around unless they give one of those WeWork charts where it's just all theoretical. It's that's a little more of a real burn. Are they like? Is there some sort of remaining performance obligations here where it's synced up to sort of backlog growth, or is this
I
just
mean,
pure
where's OpenAI's backlog going to be from?
API deals
So that's not backlog,
licensing
that's
the?
usage.
Well, there's contractual agreements there
I
that are
guess,
banked
but
out some
people
time.
probably usage has to keep growing. I want to know what the difference between this is and WeWork's business model, besides the fact that they actually innovated with a new technology. Because the actual business model is similar. You grow, you lose more. You grow, you lose more. Makes zero sense.
The one, if you're optimistic here that this is good, and I think a lot more people complain about OpenAI's cash burn because it's a private company. If they were a public company, I think you'd get a lot of investors that are just like revenue growth, revenue growth, revenue growth. Who cares about the cash burn? But the one positive I'd say is that I think Microsoft will be more willing to push the brakes on this than if OpenAI were basically truly independent, which at this point it's not. Microsoft has significant say on what they do financially. So,
Well, they're already going to SoftBank, Oracle, Google, and others. They're doing apparently a lot of this is in relation to they're building their own cloud infrastructure, that Stargate project, which I think is extremely risky. And what's funny is it probably
well,
relates a lot to this Oracle RPO. I think OpenAI, because that Stargate deal and whatever the contract is with them, is getting funded by Oracle, SoftBank, and others, along with OpenAI.
yeah, is it just meant to like take out some of their compute costs? I mean, if they're trying to go the meta route where they own their own infrastructure, I don't know if it's terrible, but I would imagine that they have a lot of systems running on Azure, GCP. I know that they announced a big deal with GCP. I don't know if they rely on AWS at all, but switching off of those systems and using solely your own infrastructure would be quite quite a lift, not only on the capex line but also on the actual business line. So if I mean, if the route is to go the meta way, where they just want to own their own infrastructure and it can work out well for them, I'd say great. But I'm yet to find a very successful example of someone other than Meta, someone saying, "We're gonna we're gonna run on our own cloud. We're gonna run on our own infrastructure."
Well, I mean Google, but yeah, I get what you mean.
Right, but they're okay outside of the hyperscalers.
I understand what you mean. Yeah. Man, there's a couple out there smaller that are niche. There's actually one, the stocks we're going to mention here, Fortinet. They have their own for like security purposes, but I understand what you're saying here, and I agree. You got to worry about an Icarus situation here. This could
What do you mean?
flying too close to the sun and just blowing up. Maybe they don't care. Maybe Altman, the Elon Musk of the world, just want to take insane risk with this. And is it going to create a lot of consumer surplus? Sure. But from a stock equity investor perspective, this has the ingredients to blow up magnificently. I mean, just look at what they are saying.
I think the difficulty is that whenever you are competing on a big TAM with big tech, you feel like you have to take insane risks to win because big tech doesn't have to do it. Like big, for example, what I'm saying here is Google can spend an exorbitant amount on Gemini and have it not really affect, well, it is affecting their financials, but not have it affect their bottom line in the same way that it would OpenAI because they have so many other business lines. I think we've seen this before. CoreWeave even is probably an example here where if you want to get relevant in a big industry like that, you feel compelled to take these absurd risks when maybe you could just build your business model out in a more conservative manner and still be fine. Maybe I'm wrong. Maybe you can't. Maybe you do have to take those insane risks in order to compete with big tech, but I wouldn't want to be a shareholder in that case.
Yeah, and guess what? OpenAI is still technically a nonprofit. This thing is a whole mess. It's a whole mess, and I'll be fascinated to follow it from the sidelines. let's do one more little thing within the AI stuff, because then we don't need to talk about it forever. We can go to some of these stocks that people recommended. There was this one people wanted us to talk about because the stock was up, I think, 100%, maybe 50%. It's a company called Nebius. You heard of this one, Ryan? Did you hear about it before today?
I've seen it floated around as a ticker.
It's a hot ticker on
I had
Twitter.
no
Yeah.
clue what they do.
Okay, so here's a quote that they tossed out. The Amsterdam based firm Nebius announced it had struck a multi year deal with Microsoft worth up to $19.4 billion to provide cloud computing power for AI workloads. Nebius, which was spun out from the Russian internet giant Yandex in 2023, provides graphics processing units or GPUs for training AI models. Just another 20 billion. Just another 20 billion, right? I'm going insane. I think we're going insane. This is not just a core, like, this is not just a competitor. This is just another core weave copycat, of which there seems to be, they sprout up like it's like a infectious disease of your garden. It's growing like wild. It's taking over. I don't even know what to say anymore about this stuff. What what
So
are
is
these business models?
the whole business model just that they happen to have GPUs in a world where a lot of people can't seem to get them?
It's gonna end. Yeah, your magic is gonna end.
They know someone at NVIDIA that
Yeah.
was willing to give them priority GPU access.
Yeah,
The
remember the company Super
that
Microcomputer?
cannot be sustainable.
Oh, yeah.
Yes, I
They have
do
a
remember.
hilarious about page too. Quote, AI is no longer a distant promise. It is becoming a defining force impacting every aspect of our lives. This is what Nebius builds vertically integrated AI infrastructure that accelerates AI innovation globally and at scale. Lots of AI. Hey, they signed a great deal with Microsoft, so kudos
Do
to
you
them.
do
But
anything with these?
nah,
Do you actually
ignore.
right. That's how I feel. Like, I see this stuff, people get so up in arms about it, and as someone that doesn't short myself, I just toss it to the side. I do not care. Like, maybe I should because maybe it has ripple effects elsewhere, but I'm yet to see that really. So, I don't know, like, I see these business models popping up and I start to think, okay, markets feel frothy, but does it affect my holdings in any way? I hope not.
Yeah, I wouldn't wanna
Does it
short the AI infrastructure companies, especially smaller ones. Um, yeah, like, I have some, as we talked about, some very small shorts across, my portfolio, like, some of the quantum computing startups I kinda think are all scams. Um, Little Palantir in there, which is larger, I don't think. Yeah, we have a comment here, "Don't short Nebius." I agree, it's smaller, and they could sign these large deals, and it could easily go up 10x and become a total meme stock. I wouldn't wanna touch that, but for something like today, Palantir, after the 10x growth into $400 billion market cap, I think if you have a diversified short portfolio, it is much less risky. Even if that stock doubles, it's not gonna kill you.
yeah, also then you start to get into a like flows situation where it's like can't is there enough money? Like
Mhm.
could Palantir hit a $2 trillion market cap? I don't know if there's enough money out there in the world to support that.
Right, and even
There
then, if
is
you have it,
probably, but
yeah, and if it's a small short, it's not gonna blow you up even in that case because I think their market cap is still like $400 billion, so yep.
size matters when it comes to meme stocks. And
Yeah, and we're gonna
do you just
talk
call these
later.
meme stocks?
Sorry, Ryan?
Can we just call these meme stocks at this point?
There's someone, we're gonna talk Open Door later, but it's a little different. I guess Open Door's business model is not too different. Buy a bunch of stuff, try to sell it, keep losing money, selling dollars for 90 cents. It's nice. It's nice money. It's nice when you can get it.
Let's take some of these stocks that listeners recommended. Where do you want to start?
Let's do Fortinet. This is one that I talked with a listener about. It's one that I struggle to maybe do a deep dive on because it's cybersecurity, and not really something I'm going to have much expertise on, but for anyone in that space and wants a stock to look at, maybe this is interesting because it seems reasonable given their long-term growth trajectory. So they're a cybersecurity company with its own cloud infrastructure. Their 10-year revenue growth annualized is 22%, so really impressive long-term growth. They're in a bit of the stock's in a slight drawdown. Their 3-year revenue growth is 18%, price to free cash flow of 30. Any interest here, Ryan, or is cybersecurity outside of your circle of competence as well? Because given the price, I feel like if I knew this industry, that's something I would go, okay, look at that historical growth. Look at this reasonable valuation. If you think it can continue, the stock can probably work.
Yeah, I would say cybersecurity outside my circle of competence. But how come every cybersecurity company has a revenue chart that looks like this? Am I sharing my screen properly? Can you see this?
Yes, I can. Sorry, I was
Revenues,
on
every cybersecurity company, I swear, every one that I look at has a revenue chart that's incredible. CrowdStrike, Fortinet, I think CrowdStrike qualifies here. Palo Alto Networks, Zscaler, I think that's Zscaler's business. Sentinel One. I could be getting. I'm pretty sure all of those are either
There's another one on
cybersecurity or
there's another one on
cybersecurity
this list
ancillary.
that I'm gonna talk about.
Yeah, that maybe it's just the industry to be in. Maybe you should just take an ETF approach or something. But yeah, I would love maybe when I hate saying that. Nah, no, it's outside my circle of competence because I feel like I miss out on a lot because of that. There's probably so much tailwinds for these businesses, just in general, like cybersecurity businesses. I'm talking about that it would be great to be a shareholder, and I wish I didn't just corner myself off and say, "Oh, no, I can't be a shareholder because it's outside my circle of competence." And typically, the other thing, if you're like myself, you're not a dev, you're not a cybersecurity expert, these can be intimidating, but typically when you own the company and you read conference call after conference call and you read shareholder letters, maybe any sort of communications, it becomes more digestible. You get to know management. You can still get a gauge on the performance of the business without knowing the specs of a product and the competitive dynamics for specific products. You can still gauge the progress of the business. So maybe I'm giving myself a little hype pump up talk here to actually start researching these things.
Look at
Yes,
these.
I would
Yeah.
love to own I would love to own one of the businesses that actually has revenue that looks
It's a
like
good
this.
pond to fish in. Yeah, yeah. Owning one of these companies that well, and look, they're not losing money. Seems like they're profitable. It seems like they're a steady grower. As a commenter here said, you have high switching costs, and cybersecurity is getting more and more important every year. So good
Yeah,
pond
do
to
you
fish
wanna
in.
be if you're a CTO, do you wanna be the one that takes the risks and gets rid of their cybersecurity supplier or vendor and then has a big breach? Probably not. That's a fireable offense. So, yeah, I imagine the switching costs are insanely high.
I agree. I agree. One to look at, yeah, if that's an industry you're interested in. Let me address. We have some comments here that says a lot of people hyping up Nebius, saying that they are. We need to get educated on it, and that these are actually they are the real deal. Maybe they are. Maybe we need to get an interview with someone that covers this name because looking at that deal, looking at what the stock has done, hey, you can't knock them so far, but uh, first glance, to me, it looked like a CoreWeave copycat. And then someone asked this question, uh, asking,
Brett, you
"Are
know
you
who,
saying?" Or, go ahead, Ryan.
sorry, I cut you off there. My internet sucks. You know who's a Nebius shareholder?
I do not.
Our good friend Ryan O'Connor, Crossroads Capital.
Ah, okay, okay. Let's see. Well, we can't go through all today, but thank you. This commenter says Heralded management team. They were forced out of Russia. I'm assuming part of the Ukraine stuff. Tons of experience in AI, not just hardware but also software. They own a European Uber. Okay, well, that's a surprise. And they have a subsidiaries. There's a JV with a Bezos investment group. Okay, well, lots of stuff. Maybe there's more than meets the eye there. If you didn't like us hating on Nebius, we're just the dollar amounts getting thrown around in AI today are just hard to fathom. I think that's what we can conclude.
Yeah. My gut reaction with a lot of these businesses is they're just getting caught up with all the excitement and fervor in AI. But yesterday when I saw Ryan O'Connor, who I greatly respect as an investor, having shares, it provides a little legitimacy, in my opinion. Do we want to go through some of these other stocks, Brett? You've got one that interests me purely because of the name here. Your stock number 3. You want to talk about this?
Sure, we can do this one. Yeah, we'll go to 2 after. It's called gambling.com, another listener recommendation. So thank you. It's a performance marketer for the online gambling industry. Feels like a pretty straightforward business, but is it a good business? I don't know. Maybe it's kind of a commodity. I'm not sure. I'd have to look into it further. Their 5-year revenue growth, 51% EV, enterprise value of 370 million. According to Fiscal AI, sometimes the aggregators can get that type of stuff wrong. So do deeper research on the balance sheet to get a true enterprise value. Market cap $294 million. Price to free cash flow of 6, EV to EBITDA of 8. Any interest here? Yeah.
Can you elaborate on what they do? Are you able to do that? Do you
I think
actually
it's
have?
they basically help like their I
It's
like
just a marketing agency, basically.
yeah, I think that's what it is. So an online gambling company goes to them and says, "Get us customers." I believe that's what it is, but I have not read the annual report. Again, these are first looks. If we get anything wrong, that's I guess the whole point of the first look is, hey, we want to decide whether we want to research something further, and these are all listener recommendations.
Okay. I generated an AI report with Fiscal AI. Shout out to them again. Gambling.com is a marketing and sports data services company in the online gambling industry. They deliver new depositing customers to online gambling operators and provide sports data services through their acquired OddsJam and Optic Odds businesses. So, yeah, I think you're basically right. It's sort of a third party marketing agency that I'm guessing maybe the DraftKings of the world rely on to attract new customers. Yeah, margins are phenomenal for advertising agencies. I think gross margins for gambling.com was like 95%. Yeah,
Yeah, and
94%.
this commenter Simon, who I think is the one that recommended we take a look at this company, says 75% of the business is affiliate marketing, 25% is sports data subscription services. So that could also be interesting. That's not bad.
I've always, okay, sports gambling. There have been a lot of companies. I've always wanted somehow a bet in this industry, and it's been really hard to get behind sort of the DraftKings of the world because that industry is just hyper competitive and you are paying absurd sums to probably companies like gambling.com to go out and attract customers. Now, maybe the lifetime value of those customers is worth it, but remember in 2020 when they were giving you like first $200 of bets free, like just absurd offers to get people to come through. That's not really a business I want to be in, especially if you're a business where you have to pay to acquire customers twice. I mean, it's kind of difficult when it's so competitive, but this seems like sort of a picks and shovels provider to an industry that I definitely would be happy to be invested in.
Yeah, it seems like a good industry, profitable, and Lindy. So it's been around. It's been
People
around a
love
long
to
time.
gamble.
Yeah, people like to gamble. People like to bet on things. People like the excitement, and I don't think it's going away, whether legal or not. This is one where regulation and regulatory and legal stuff can matter a lot. That kind of get throw a wrench in the mix of some things, but doesn't mean it's a terrible industry.
Shout out to whoever gave this recommendation because I am actually going to look at this further. I really like this. So thank you. And if you have any further research on it, feel free to send it my way because I'd like a little shortcut on some of the research.
That should inspire you to join the Substack chat for the podcast, Ryan, because that's where we are discussing it. Let's see. He also says they have a revenue split with a lot of the operators. Okay, well, interesting. Maybe it's more than just marketing. And we have another guy that is not happy about your bad internet. Says it's how do you have bad internet in Austin? Well, he is traveling because we are at a conference. So this is the last week for that. Then the
Yeah.
internet will be perfect. Let's see.
Yeah, my
All right.
apologies for the internet, but it will get resolved. Bear with us. I am
Yeah, I think
not
it's
at
okay.
my office, not at my regular studio. Do you want to
Yeah,
talk about Rubrik?
sure, sure. Rubik. Well,
Is
let's
this
do the
also
first one here.
cybersecurity?
Let's do number two. Let's not skip number two before we get to number four. Yeah, Rubik's also cybersecurity, but this one I think I'm a little more interested in. It's called SamSara, ticker IoT. It is an Internet of Things connector, hence the ticker. And they take data that a company generates from an on site operation, like a factory or even your car. I think they have a partnership with a lot of automotive manufacturers. And then they upload it to the cloud, process it, help you analyze it. Founded in just 2015, but they already have a $24 billion market cap. EV to gross profit is 20. EV to sales is 16. They have pretty high margins, pretty high revenue, 5-year revenue growth rate of 60%. Clearly EV to gross profit of 20 is fairly expensive, but I'm interested in this company. It seems like a promising business. I mean, just look at that growth rate. And I think it's something you can understand. Look, these companies want the data from these physical operations, but it's just really, really hard to manage. You probably need someone in there to do it.
Yeah, great ticker, IoT. That's
Always
that's got to
helps.
be worth something. The so my only concern from the limited information that I have on this business now is it sounds like this is like very custom solutions on a per customer basis would be my guess. It's not like a one size fits all SaaS model, which isn't bad. I mean, you can build a great business doing that, but operating leverage is typically somewhat capped when you have to create custom solutions for each customer. I could be totally wrong, but it sounds like that's kind of the model here, given that they're going, given that each business where going from on-site to cloud data probably has different needs, different requirements. I could be wrong, but if it is a SaaS model here, I'd probably be more interested.
Yeah, I think, yeah, I'm not sure the exact business model. That's about what I got introduced with on the first glance. But the whole point of this is to say, should we research it further? I think this one for sure. For sure. All right. Last one before we get to some other topics. Rubrik, another cybersecurity company. Um, their website says at Rubrik, we help enterprises achieve business resilience against cyber attacks, malicious insiders, and operational disruptions. We just secure data where it lives across enterprise, cloud, and SaaS, making businesses unstoppable. If you told me that was the definition of any of the cybersecurity companies, I would not be able to tell you between any of them. Like it just kind of shows I don't know anything about this industry, but their market cap is $18 billion. EV to sales 18.5. I feel like every single cybersecurity company trades at 15 times sales. Last quarter, which was out today, I think that's why someone wanted us to talk about it. Their ARR was up 36% year over year to $1.25 billion. 80% gross margins, should probably have CrowdStrike level margins at scale. Any interest in this one?
Yes. They went public recently too. I want to say maybe a year ago, 2 years
Yeah.
ago. The you're right. If you just gave that definition, we help enterprises achieve business resilience against cyber attacks. That's not super specific. It could apply to seemingly every cybersecurity business. I I go back to the same thing. The one thing I will say is I knew a guy who worked at Rubrik, and he gave me a bit of the investing ick, so to speak. But usually that's the employees are not always that indicative of what you can actually get returns from. So that was just a side anecdote. But I go back to wanting to expand my circle of competence here because the tailwinds are huge. And it feels like every cybersecurity company, once again, if I pulled up the ARR chart, my suspicion is it's going to look a lot like the chart from Fortinet, which is just
True.
20, 30% annual growth on the top line. And it's not like there's always going to be questions about profitability with these businesses. And people consistently look at it and think they're paying so much for that growth. Yeah, because they can. They know what the lock-in is here. Like customers don't want to switch. There's reputational risk when you're the person at the company that decides to switch these. I've got never mind. Sorry, something popped up for listeners when I did a thumbs up. Anyway,
Yeah, you
there's
can't do thumbs up
reputational risk.
on an Apple device. No thumbs up. That's the innovation that they have.
Yeah, thanks, Apple. There's reputational risk, but also it's a pain. It's just a pain to switch cybersecurity providers. It's not one of those things. It's like a direct revenue benefit. So there isn't necessarily this urgency to switch cybersecurity systems. It's more like insurance. So there's huge switching costs, which means, yeah, you can pay a lot in terms of development expenses and sales and marketing to get in front of customers today because that ARR is true ARR and it might be multi-year recurring revenue. So I think with these businesses, yeah, the top line is probably the most important to pay attention to because they can manage a lot of the expenses without losing much of it. So, yes, I want to look at this. I want to look at the entire cybersecurity industry. The only issue is seemingly everyone looks like it has kind of an insane sales multiple,
And they
which is a
all
little hard to
describe
digest.
and they describe themselves all the same as their businesses. Maybe we need to get a good interview on. If anyone has any recommendations for industry coverage, let us know.
Yeah, it's the basket approach. Maybe that's the way to go.
Possibly.
Basket approach. I
Possibly.
haven't taken a basket approach on anything in a long time, but it just feels like all these cybersecurity businesses are they are unique. I get it. They're not all offering the same things. It feels like you are or they are if you're not in the industry, but they just grow. And one of them is going to be probably many of them are going to be much bigger businesses. This would have to be one you kind of close your eyes on and put it in the 10-year bucket and because it's going to be hard to palette the valuation and multiple compression could be a real risk for a lot of these, especially in the short run.
Related to our David Gardner interview, I'm sure he has some cybersecurity stocks in his portfolio, and just given that it's such a disruptive, not a disruptive industry, I guess listen to the interview or read his new book, and you'll understand that that's an industry he would target. He wouldn't really worry too much about what we're worrying about right now, for better or worse. It's just how he invests. But we have a listener question that I want to get to some bubble watch topics. This one I think is fun. I was thinking about it for about a day, so maybe I can go first if Ryan can't come up with something right away. What is the cheapest stock on your watch list, and why haven't you pulled the trigger? Anything come to mind, or should I go first, Ryan?
Go for it. I do have some things that come to mind, but I'm going to sort through them to pick a single stock.
Well, what popped to mind is Lululemon. We already talked about it. It's definitely the cheapest on my watch list. I think you posted from the Fiscal AI account today. Their EV to EBIT, maybe a different metric, is now below 8, trailing forward. It might be slightly higher because of the earnings headwinds from tariffs and a few other things. I don't know. I feel like I should. Part of me feels like I should just own this, plug your nose, buy it. It may not work. It may work. But if it does, it could be a multi bagger over a 5-year period. I don't own it because I have my rule about apparel. And the farther it drops, the closer I get to breaking it. My gut tells me it's going to work.
Yeah, so I guess it depends how you measure cheapest. if we're doing it based on trailing figures, the cheapest for me, I don't have Lululemon on my watch list. I'm going through my watch list right now. The next cheapest, which technically is in my portfolio as well, would be the Latin American airports, the Corporación America airports cap. I think it's an EV to EBIT of like 7 or 8.
Yep,
So
and stock fell off after some political news yesterday.
yeah, I don't see anything that's the home builders are close to that level, but forward growth probably looks a little different for those than it does for the airports. Airports seem to have slightly more predictable earnings growth. So it would either be the home builders or CAP, Corporación America Airports. Why haven't I pulled the trigger? Well, I have. So unfortunately, I cheated the question, but it's only a small position at the moment. So I could maybe the question still applies. I kind of get worried about some of the political risk, even though maybe I shouldn't. The issue for me when it comes to a company like this, where they operate primarily in Argentina, isn't necessary. Like I can get comfortable with some of the geopolitical stuff. I just hate being so late to news. Like it feels
That's
like I'm
true.
so slow getting information. Like stock dropped 8% yesterday. It took me like quite a bit to figure out why, especially for stocks that aren't like super popular. Uh, Cap is kind of popular, but you kind of have to do some digging to figure out what's going on. I'm just not as in the know on a lot of the political topics which could impact the business. So I hate it's not that it can't end up in my portfolio, it's that I just don't want to have a huge chunk of my portfolio where I'm constantly like, wait, what happened here? Like what happened with the news? And yeah, that seems to be the case constantly with some of these international stocks.
All right, let's close out with Bubble Watch. There's some ones that, if you weren't worried about a bubble with AI and all this stuff before, maybe I can change your opinion with this press release that you could or could not have seen yesterday. Ryan, I have the link in here if you want to read it yourself. And it's about a company called 8Co Holdings, ticker Octo, OCTO. Octo or 8Co Holdings today announced the pricing and signing of a private placement for the purchase and sale of approximately 171 million shares of common stock at a price of $1.46 per share for expected aggregate gross proceeds of approximately $250 million. Blah, 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 blah. Why am I saying this? Because they are implementing the first of its kind world coin treasury strategy. In addition, 13 million shares of common stock were issued to Bitmine for total proceeds of $20 million. Octo stock currently trades at $40 a share as of this writing, and along with the announcement was a picture of Dan Ives and Tom Lee, say the two most bullish guys that go on CNBC, pointing to the orb of WorldCoin. If you don't know any about this WorldCoin orb stuff, just look it up. You'll know what I'm saying. They're pointing to it like it's a celebrity you see at some event, like, hey, I just met LeBron. Pointer finger. This is something that, well, I worry about the morals of the investors in this. And maybe they don't care because they had, I think, a 50 bagger in 8 hours. That's the world we live in.
They got to be getting paid for these promos, or maybe they just
Well,
know
they got
they'll
a deal
make
at
money.
$1 a share. They're getting paid.
Yeah. What can we still call this the golden age of fraud? This feels like golden age of fraud type
I think it's
topics.
more of I think it's transitioned from the golden age of fraud to the golden age of pump and dumps. It's a
Yeah,
renaissance of pump
that's
and
fair.
dumps, 1910s, 1920s style. Speaking of which,
Yeah.
you wanna get an update on Open Door? We got about 20 seconds so I can close
The
things out here. This is
ultimate
a pure
clear pump and dump.
Yeah, this is just pure clear pump and dump. People don't really care. There's that one guy going to Drake's house. If you think we're
What is he
talking
doing?
Yeah, if you
What
think if
is he
anyone listening to us
doing?
thinks we've lost our minds, we have not lost our minds. These are things that have definitely happened that people are somehow doing in the investing world. I think the cost of capital needs to triple overnight. Open Door is now at $6 a share, 10 bagger from a lows a few months ago. I'm seeing people on Reddit bragging about 7-figure Open Door portfolios and asking if they will go to $200 or $300 a share. I'm going to close things out. Is this a good short?
It makes me happy to think that Drake probably has no clue who this person is, and he spends so much time outside his house trying to be relevant in some way. This is the most in I almost hate the fact that we're giving it attention. This is the most insane guy in finance at the moment. Michael Saylor, you have been topped. Congratulations.
No. What about
This
Pulte?
is
Pul There's a lot of competition.
this guy's worse. This guy's worse. It's so like he's so blatant about it too. Like he doesn't care that it's a pump and dump. And I think he ended up having to take posts down because he said something incriminating online. So please, if somehow you've gotten to the end of this podcast and you are debating whether or not to own shares of Open Door, just know that
Just say
there's not
no.
a whole lot of legitimacy behind the business model.
Yeah.
When they have to report earnings, it's always going to be a rough time. So maybe you can, maybe you know what? I take it all back. Maybe I should just have an emotional hedge and own the stock. Like, because I'm
Just
so
say no to
frustrated
meme
by this
stocks.
guy.
That's what I say. Yeah.
Yeah. Yeah, it's funny. Do you ever talk to people about this stuff in real life? And they're like, what on earth are you talking about?
Yeah, it's that Breaking Bad meme for sure. Yo, did you see Aiko Holdings? They're buying a bunch of WorldCoin. Tom Lee's involved. Like, you just talked to me in Portuguese. But yeah, someone said close the door on Open Door.
Yeah.
That's a good tagline. I like that. All right, we're going a little long. If anyone listening to this is this is gonna be out after. We're gonna be at a conference called FinCon. If you're there, let us know. I'm sure we'll see you. Thank you everyone for listening. Thank you to our sponsors, Interactive Brokers, Fiscal AI. Check them out. Use our link. Tell them we sent you. Get your discounts and all that good stuff. We got some maybe more exciting sponsors coming down the line next week or the week after. So we're excited to share that. And as a disclosure, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan and I or any podcast guests may hold securities discussed in this podcast. They've held them in the past and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in on the live show. Typically, these will be Thursday, 5 p.m. Eastern Time, and the recording's out Friday morning. We'll be back to our regular scheduled programming next week, and we'll see y'all then.